Hello everyone. Welcome back to the channel. In the previous video, we explained the key concepts of generally accepted accounting principles, GAAP, and why they are important. Today, we're moving from theory to practice. In this video, I'll show you real, practical examples of how GAAP principles are applied in actual financial statements like the income statement, balance sheet, and cash flow statement. By the end of this lesson, you won't just know the principles, you'll understand how they work in real business situations. Let's get started. 1. Revenue recognition principle income statement example. Under GAAP, revenue is recorded when it is earned, not necessarily when cash is received. Let's take an example. Imagine a consulting company completes a project worth $10,000 in December. The client will pay in January. Under GAAP, revenue of $10,000 is recorded in December. On the balance sheet, accounts receivable increases. On the income statement, revenue increases. Even though cash hasn't been received, the revenue is earned. This follows GAAP standards issued by the Financial Accounting Standards Board. This ensures that income reflects actual performance, not just cash movement. 2. Matching principle expense recognition. Now let's apply the matching principle. Assume the same consulting company paid $2,000 in salaries to employees who worked on that December project. Under GAAP, the $2,000 salary expense must be recorded in December. Even if salaries are paid in January, the expense belongs to the period when revenue was earned. On the income statement, revenue $10,000, expenses $2,000, profit $8,000. This ensures accurate net income. If we recorded expenses in a different month, profit would be misleading. 3. Historical cost principle balance sheet example. Now let's look at the balance sheet. Suppose a company purchases equipment for $50,000. 2 years later, the market value rises to $65,000. Under GAAP, the equipment remains recorded at its original cost of $50,000. It is then reduced gradually through depreciation. Why? Because historical cost is objective and verifiable. GAAP prefers reliable numbers over estimated market values. This prevents companies from inflating asset values to look more profitable. 4. Conservatism principle handling uncertainty. Let's consider bad debts. A company has $100,000 in accounts receivable. Based on experience, it estimates that $5,000 may not be collected. Under GAAP, the company records a bad debt expense of $5,000, creates an allowance for doubtful accounts. Even though the loss hasn't happened yet, GAAP requires recognizing probable losses early. This follows the conservatism principle. Anticipate losses, but do not anticipate gains. Prevents overstating assets and income. 5. Full disclosure principle notes to financial statements. Now let's say the company is involved in a lawsuit that could result in a major financial loss. GAAP requires disclosure of this information in the notes to the financial statements. Even if the loss hasn't occurred yet, users must be informed. Public companies submit these disclosures when filing reports with the U.S. Securities and Exchange Commission. This ensures transparency for investors and creditors. Without disclosure, financial statements could be misleading. 6. Consistency principle, comparing financial statements. Suppose a company uses the straight-line method for depreciation this year. Next year, it decides to use a different depreciation method. Under GAAP, the company must disclose the change. It must explain the financial impact. Consistency allows investors to compare performance over time. If accounting methods change without explanation, analysis becomes unreliable. 7. Economic entity assumption owner versus business. If the business owner withdraws $3,000 for personal use, it is recorded as drawings or owner's equity reduction. It is not recorded as an expense. GAAP treats the business as separate from the owner. This ensures accurate financial reporting. Conclusion: GAAP in real life. As you can see, GAAP is not just theory, it directly affects when revenue appears, when expenses are recorded, how assets are valued, how risks are disclosed, how profits are calculated. Every major financial statement you see is shaped by GAAP rules. Without GAAP, financial reporting would be inconsistent and unreliable. With GAAP, users can trust and compare financial information confidently. Now you've seen GAAP in action through practical examples. In the next lesson, we can compare GAAP with international standards like International Financial Reporting Standards and see the key differences. If this helped you understand accounting better, don't forget to like, subscribe, and share. Thank you for watching, and I'll see you in the next video.